Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the 7th part on the series on the financial accounting ratios, turnover ratios. Hope you will like, share and subscribe our channel. Turnover ratios. The 5 standard financial accounting ratios: liquidity, profitability, solvency, turnover and earnings ratio. Introduction. There are many names for turnover ratios, as they are also called as activity ratios or efficiency ratios or acidity ratios or performance ratios or asset management ratios. This assesses a company's operating efficiency. Operating efficiency is the time a company takes to convert its inventory into sales and repay its suppliers using the sales proceeds. This cycle of converting inventory to sales and paying to suppliers is called the cash conversion cycle. Converting inventory to sales quickly also helps companies receive revenues sooner and avoid borrowing money to run their operating expenses. These ratios are calculated on the basis of revenues from operations. Therefore, these ratios are also called as turnover ratios. Turnover indicates the speed or number of times detailed above the capital employed has been rotated in the process of doing business, also known as efficiency ratios, as it measures the efficiency of operations of a firm on the basis of effective utilization of its resources. You can estimate operating efficiency by either calculating the length of a company's conversion cycle or the number of cycles it completes in a year. In other words, these ratios indicate how efficiently the working capital and inventory is being used to obtain revenue from operations. Higher Higher turnover ratios indicate the better use of capital or resources and in turn leads to higher profitability. Note, the more the better. The types of turnover ratios: fixed assets turnover ratio, inventory turnover ratio, total assets turnover ratios, accounts receivables turnover ratio, and accounts payable turnover ratio. Fixed assets turnover ratio. This fixed assets turnover ratio is an efficiency ratio that measures the company's return on their investment in property, plant, and equipment by comparing net sales with fixed assets. In other words, it calculates how efficiently a company is producing sales with its machines and equipment. Investors and creditors use this formula to understand how well the company is utilizing their equipment to generate sales. This concept is important to investors because they want to be able to measure an approximate return on their investment. This is particularly true in the manufacturing industry, where companies have large and expensive equipment purchases. Creditors, on the other hand, want to make sure that the company can produce enough revenues from a new piece of equipment to pay back the loan they used to purchase it. Formula: net sales divided by average fixed assets. Ideal 2.5 or more is generally considered good. Inventory turnover ratio. Inventory or stock turnover ratio measures the efficiency at which the inventory of a company is turned into finished goods and sold to their customers. Inventory turnover is the speed and regularity with which your organization sells its physical goods. The purpose of measuring inventory turnover is to identify how many units of inventory your business has sold in a specific period compared to your units of inventory on hand. The inventory turnover ratio reflects the frequency of your inventory turnover, the number of times your inventory turns over within a specified period, relative to its cost of goods sold, that is COGS, for that same period. Formula: cost of goods sold divided by average inventory. Ideal between 5 to 10, but depends upon industry to industry. Total assets turnover ratio. Unlike other turnover ratios like the inventory turnover ratio, the asset turnover ratio does not calculate how many times assets are sold. Instead, it looks at how efficiently assets are being used. Since company assets require a great deal of investment, management spends much of its time deciding what assets to purchase and when assets should be purchased or leased. Assets play a crucial role in a business' ability to earn and generate income. For instance, a manufacturing plant wouldn't be able to manufacture products without proper machinery and manufacturing equipment. Formula: net sales divided by total assets. Ideal: an asset turnover ratio of over 1 is always considered good. A high ratio means the company is earning more revenue by fully utilizing its assets or employing its own resources. Accounts receivable turnover ratio. Financial indicator called the accounts receivable turnover ratio is used to assess how successfully a business collects payments from its clients for credit sales. The effectiveness of a company's credit and collection practices is calculated by the accounts receivable turnover ratio. It is figured by dividing net credit sales by the average accounts receivable during a given time frame. It measures how frequently a company converts its accounts receivable into cash over a given time period. Formula: net receivable sales divided by average net receivables. Ideal: a lower ratio shows that a company is taking longer to collect its receivables, which could be the cause of concern, while a higher ratio shows that a company is collecting its receivables more rapidly, which is typically considered a positive indicator. Accounts payable turnover ratio. The concept of account payable turnover actually goes back some time. The Des Moines Register of April 15, 1967 printed report written by an association for secondary schools and colleges. This report includes a quote from a business manager who said, "The rapid expansion of physical plant facilities for the college, that is, to the extent to which they are funded out of current revenue, has tended to decrease the rate of accounts payable turnover. The result has been an inordinate amount of the time spent in scheduling the payment of back accounts and in discussing these balances with creditors." The accounts payable ratio measures the number of times a company pays its accounts payable during a given period, that is typically a year. It is the essential financial metric as it reflects the effectiveness of the company's credit and payment policies. A high accounts payable turnover ratio indicates the company has an efficient and timely payment system, which is important in maintaining good relationship with vendors and suppliers. Formula: net credit purchases divided by average net payables. Ideal: good accounts payable turnover ratio in days, that is DPO, is determined by benchmarking with your industry and your business. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share, and subscribe our channel Accounts and Finance with FARSK. Thank you. Have a great day.